let's say I have the money here. Obviously, should I spend this money or should I use a policy loan? Well, I want to spend their money. I recycle the money through the system and they go, well, isn't that just make work? Why would I do that? It's subtle. And I know you get this already, but it's not just about the fact that I'm now using Equitable's money. I'm also becoming a customer, a borrower from my own company. And then I'm taking the money I worked for and I'm giving it back to the company that I now co-own so that they have control of that volume of money. I can't illustrate the difference that that's going to make, but we know just by virtue of understanding how a business works, we're contributing to the profitability of that company and they have to share the profit with us.
So the one thing I wanted to kind of like go over was like the policy loan repayments and then like the interest that we're paying back to our policy. So last time we spoke, you had like broke down some of your loan amounts into like smaller amortized portions. So a lot of the times I'm taking stuff like it's a larger dollar value, like 10 grand, 11 grand, 10 grand. And then there has been some smaller. When I did repay.
Real quick before you do that, like when you take, let's say 10 grand, like are those because you're doing like lump sum, like debt recapture, or do you know specifically what they were just going on the line of credit and stuff?
Yeah. So this, like the first 4 here were to my truck, and then we paid for a trip to Toronto, Vancouver Island, and then just some smaller other things.
Okay, perfect. Yep.
When I repaid, so I did 2 or 3 repayments in early 2022. One was for $7,200 and then one was for $2,500. And then there was another smaller one for just over $600.
And is that going to premium or is that going to loan?
That was loan repayment, these 2 here, the 7205 and 2538. So then I mark it if it's policy loan repayment. So I would probably most likely be doing like the larger lump sum repayments.
And is that just because, is that, you know, what you pile up from just extra cash flow and whatnot, then you just lump it in?
Mm-hmm. It's about $1,500 every 2 weeks. We're kind of putting away for policy, like IBC and stuff right now. So I was calculating like the interest expense at say like 6.2%, and then interest expense at say 10% if we were going to repay it. And I was like kind of getting like confused if I should like do it your way, like breaking it down, amortize it, and then you can do like those different prepayments or whatever. But then I was like, well, maybe if I just do lump sum and then at the end, say I pay off this 10 grand, just throw 900 in as policy loan interest. I'm not sure what the best way or what's the
when you say throw
typical way.
900 in as policy loan interest, are you saying like would that go back in against a loan or as premium? Do you have any premium that can even go in at this point or no? You know what I mean, the EDO?
Yeah. So I just did like Monday or Tuesday, I might have sent like 11 grand for Desiree as EDO.
Okay. And is that, just curious, like where does that come from? Like what's that pool or?
That was just what we've saved up over the last couple months. And then I fired it in there. So I did this bottom 4 here is what I've done in the last few months. So July, August, September, October.
Oh, EDO?
So the 7,500 was Desiree's base premium, policy premium. And then I did EDO for Desiree. Then we did Margot's base premium. And then I did Desiree for EDO.
There. And then you're able to track that against, like, you know how much could go in. So you're basically just subtracting that somewhere.
So this is how much I've put in already. And then we can put in say 77,000 each year.
Is that EDO alone or is that total?
Total. So yeah, total premium in EDO, 77,795. So you all 3 policies.
Yeah. And you know, roughly, like, you know how much, for example, you could look somewhere, you could break it down, you know how much can go into the Desiree specifically. So you can look back and go, okay, I put in 15 or whatever. And
yeah, that's this page here is where I have it.
Yeah. I mean, to me, like, look, here's the thing. I can give you guidance. The good news is what works for Tyson is the way to do it. Okay. So if you're doing lump sums and I mean, if you're, as long as you feel like, hey, I know I'm putting money, because let's face it, like the money that you're saving up, a lot of it, not a lot of it, but some of it, because I know you have good cash flow, you're saving money anyway, but you're not making the truck payment anymore. So a part of that
No.
savings, it's being, you're building up more savings because what would have gone to the truck is being added to your savings.
Yeah.
And then you're lump summing it back into the policy as loan and or premium. And so if that feels like, that's literally what I did for up until 6 months ago. So if that works and that feels good, then great. Even the whole like tracking of interest, I mean, it depends on you. Like that's why I started using the policy loan tracker, because it was more for things like this one here with the truck. I mean, that's pretty simple because you pulled out the loans, you paid off the truck, then you're sending a bunch of money back, and then you're taking out loans and lump summing it onto your line of credit, right? Did you use the line of credit to pay off the truck initially and then you use policy loans?
No, I just lump summed it to General Bank, who had the original truck loan. And then like some of this other stuff, so like this 11,000 that we just sent as EDO for Desiree, as soon as it's at Equitable, I'm gonna pull a policy loan and use it to pay for the painting for the new house.
See, this is where what I don't do, like, because obviously I use the capital for living expenses, right?
Yeah.
So if I just spend my regular, gas, groceries, lights, whatever, my income comes in, I lump sum it into the policy, like basically money that I would have used for living, lump sum that back in the policy and store it there until I need to use it again. So I don't follow a loan tracker for that specific use. What I add to my loan tracker is things like what you're talking about. Oh, we went to Toronto, we went to Vancouver, we borrowed money for painting. Oh, okay, because then at least now you're going, okay, I borrowed money out for painting, and you just kind of act as if. How would you have paid it before? If it would have came from savings, well, that's fine. You would have fairly regularly, you would have been saving money again to replace that 11 grand that you used for painting. So just think for yourself, okay, if I use that for savings, how soon do I want to pay that 11 grand back? What's a payment that I'm okay with? I could put it in my tracker. I could divide it up over 24 months, add my 10%. And now I know every month I'm paying whatever that number would be, $250 or whatever is going back into the policy as a loan repayment. And you could pick a specific policy. So for example, if you're lump summing money in anyway, you maybe, and then you just put money into Desiree's for EDO. I'm trying to make this clear. So let's just say you're focusing right now on topping up Desiree's EDO, right? So you could use your loan tracker and just be paying the loan tracker back to your policy, because I'm assuming there's either premium or a loan balance outstanding, right? So this is just what I do. The loan tracker that I'm following, I'm literally putting it in one specific policy because I have a specific reason why I'm doing that. But that loan tracker, whatever it tells me I have to pay, I pay it to that policy. Okay. If I have lump sums and whatnot, I'll put it in different places. So if you're doing like lump sums anyway, you could put your lump sums, let's say in Desiree's policy, and then you're following a loan tracker, you could be pumping that back into your policy just so that you don't have to do that either. You could all put it all into one, but that's just what I do. I kind of break it up just so I can show clients, right? Like I'll show them, hey, I borrowed out this much at a certain day, and here's how much I paid back in July. Here's how much I paid back in August. Here's how much I paid back in September. And then here's how much I can borrow, right? So I can show them I paid back 15 grand. I can borrow 17. Isn't that good, right? That's kind of why I was doing it. But if you wanted to track it differently, you could be like, hey, I'm focusing on loans on my policy and premium on Desiree's. Desiree's premium's paid up. Great. I'm going to focus on premium on mine and loans from Desiree's. But I personally always do my very best to prioritize premium over loans. Again, not saying not to pay back the loan, but always, even if I'm doing a loan tracker, sometimes that loan tracker will go back in as premium. Yeah.
See, that's what I've been kind of doing too, is doing the lump sums as EDO, because you told me that last year to prioritize premium and EDO over policy loans. Then I was just like curious how to capture like that interest expense if I could just, as long as you're putting money back in, you're pretty much covered.
Yeah, that's just it. Like it's harder to track the interest unless you're following a specific payment. And even
so would it be
even lump summing, like unless you're paying back the entire loan, if I borrowed out 10, I can pay back 11 because I know 10% is 11 grand, right? So if you're just doing, it's harder to track it and make sure that you're paying back more. But at the end of the day, you're recapturing as much as you can. Like you're slamming a lot of money in there. You know what I mean? Like, I don't know if that kind of makes sense to you, but.
Can you so say like our total premium and EDO that we can put in is 77,000. Can I put more than that in? Or is that the absolute max?
For premium, it would be no.
But can I put like say 3 grand back in as interest?
Well, you could. Okay, so I'm looking at your policy, right? Just because I happen to have it open. So I noticed that there's like almost 27,000 is the outstanding loan.
Yeah.
So if you and your premium, oh sweet, you and I are almost on track. Mine's November 3rd, I think. So your premium is coming due here soon.
Yeah.
So that means that you're going to have a bunch more, almost 29,000 bucks a year that can go back into yours if you don't put the whole 41 in. So you're just need to put in 12.6 now.
Yep.
If you max out the premium. If you put in let's just say the whole 77,000 for that given year, even though there's different anniversary dates or whatever, your premium's maxed out in all the policies, and you wanted to put a bunch more in, you could, but it wouldn't go in as premium. It would go in as a loan repayment. That's the only thing you can do unless we expand, which we're not going to do that now. So it's like on stage, I shared Nelson Nash's 6th golden rule, which is create capacity for windfalls. Well, if you have a windfall, if we have all our premium paid and no loans outstanding, just take a big loan out and do something with it. And then the windfall can go in the policy against the loan. At least it gets stored in your private system, right? So that's the idea. That's why idea. Sometimes people say to me like, oh, I have a loan outstanding. I really want to get it paid back. I go, yeah. And then, well, I have loan balance, paying it down, paying it back, paying it down. Like I always have a loan balance outstanding somewhere.
Yeah. And I think we have about 57,000 outstanding right now.
Yeah, there's about, and have you, just curious, not that it matters, have you used Margot's policy as well or no?
Yeah.
For loans and stuff?
Yeah, I pulled one loan from hers for my truck. So like my plan for the next couple months is I'll probably like for the next little bit, save the next month ours, pay my premium, and then the rest of the year will be EDO. Yeah,
like she's got, so Margot, for the second year here, you paid the base only for now.
Yeah.
There's another almost $3,000 that can go in there. And then, yeah, if I look at Desiree's got, so she's got about 27, almost, not quite, but your loan and her loan are very similar in terms of what's outstanding. So hers is like 26,925, hers is 26,899. And then when did you, so her base is 75. So almost 32 is almost just over 31 is the total. So that would bring you to like 39,000 of premium because you paid the base and then you paid another 11, right? Okay, sweet. Yeah. So like her paid up additions is like 212,000. There's also something else called an in-force illustration, which is kind of cool. But the only problem with the in-force illustration is it shows you that like what would happen projected forward in the policy. But if there's a loan outstanding, it assumes that you're never paying the loan back. So it shows you how it capitalizes, but it's kind of cool because it shows another column that shows net cash value. Okay. Because it's basically your total cash value minus the loan, which isn't how it goes, but you know what I'm saying? But the only problem with those, the reason why those in-force illustrations aren't really that great is because it assumes that only the base went in. It says that there's a note at the top of it that says this is assuming that no EDO has gone in like for this year or moving forward or something like that. But it's still kind of cool to look at them.
But I can already see like the power of it, of always having money available. Like even like this move was expensive, but it was like we were able to paint the house, and I was like, well, we're gonna have policy loan available. It's not how I wanted to do it. Like banks were incredibly difficult to deal with. Like I wanted to include it in the mortgage, but anyways, I was like, we can do it with policy loan. So I've used it. So a couple trips, painting, taxes. I used it to pay house insurance for an annual. Used it to pay my truck, our enclosed trailer, and our side-by-side insurance for the year. I'd already done our RRSPs, had redirected them to policy loans, and then now I'm doing our TFSAs to policy loans too. So the money that we were putting into those two TFSA RRSPs are now going into policy. So what I do is every 2 weeks, like right after, so we get paid Thursdays, Friday morning, there's an automatic withdrawal from my checking to just a savings account. And I build that up for a couple months, and then I fire it off to Equitable.
Okay, so you said just quickly, you'd said that you use the policies to pay off your truck, home and auto insurance, and you also said like a trailer and a side-by-side, right?
The insurance for those, yeah. That was just like September I used it to pay for that.
Nice. And so again, like it's up to you, but those are things too, like even if like the truck payment, let's say, I don't know if you normally do it annually anyway, you probably did. Did you pay your insurance annually before anyway, just with own cash instead of a loan? You paid it monthly? Okay, cool. So that, again, that's up to you. Like you can do it. Doing it lump sum the way you're doing it, it's fine because you're just basically saving the money that you would have been paying them anyway. Because I know you're disciplined that way. Most people just aren't disciplined like that. So you're already saving the money and lump summing it back in. But that's what I'd add to my trackers. I'd say, okay, I just used whatever, $3,600 for insurance, policy loan, put that in there. I bust it up over 12 months. I add my 10%, and then I just look at my one single payment that needs to go in. And I do that again, partially because I kind of want to have that track record, that evidence to show people, hey, here's how you could do it. Not everyone's going to connect with that. Some people look at it and they get overwhelmed and they just want to do it, as long as you're sending money to the system. So that would be an example. But so you've used it for truck, a bunch of different types of insurance, property taxes, a couple of trips, and painting. Did I miss anything?
No, that's pretty much it. Oh, I used it to pay my taxes this year.
Oh, right. Your personal income tax?
Yeah.
And did you basically have that because you stopped putting money into RSP or what?
Yeah, and then I don't know what happened, but my work savings plan, so non-registered savings plan through Sun Life rebalanced the portfolio, and I had like a $27,000 capital gain in that account, and they just rebalanced the portfolio.
But it was okay. It was non-reg, so you basically pay the tax annually on the growth.
So then I got the tax. It was $27,000 in capital gain, and then combined with not putting in RRSPs. And I had higher income last year from our rentals. So they were all net positive, not negative. So then I got a big tax bill.
What was the tax bill? That sounds pretty hefty.
It's just over $8,000.
Oh, that's not too bad. But yeah, still, that's just it, right? Like I say that to people. And the thing is people are so conditioned. They go, oh, what if I might have to pay taxes or whatever, because I stopped putting money in my RSPs or whatever. And it's like, well, what are we getting on the back end? Like, look at the things that you're able to achieve rather than putting the money into the prison, because you were probably you're savvy already. You're already creating cash flow and stuff. You were putting it in there probably just to offset taxes for the most part. Is that pretty much
100%? So I'll show you. I've created a sheet here. You see that? It says premium and EDO savings. We have a joint savings account, Desiree and I. So 500 monthly goes into that. So we're going to use it as premium or EDO as well. My RSP, I was putting 1,000 a month into that, which is now going to premium. Truck payment is now going to premium. My vehicle insurance. So I just did my annual premiums for this year, how much I need to send bi-weekly to make sure I'm still.
Oh, you're sending that to some kind of an account and you're lump summing it from the account. Is that what you said before?
Yeah. So I just took whatever I used policy loans for, divided it up bi-weekly, came up with an amount, and then I'm sending that to the savings. The new house insurance, the new property tax.
If you're doing it that way, it's up to you. What you could do, because remember we were talking about the interest?
Mm-hmm.
What you could do is, if that's what you normally save, let's say, for example, your premium vehicle insurance, $187.75 was the monthly premium. Is that right? You could take that and you could multiply the total amount or whatever you want to do. You could multiply that number by 1.1.
Mm-hmm.
And that's basically 10% on top of what you would have been paying. That's one way you could do it. So you go, oh, okay, I'm still putting my 10% extra back into the system type of thing, right?
Mm-hmm.
You could do it that way. You beef up all your payments, and because again, all you're really doing is saving more in your own system type of thing. But
yeah, and then property tax, Desiree's vehicle insurance comes up in December, so we'll do the same thing there. Use a policy loan to pay that.
Yeah, this is perfect. Like the only
redirected her RSPs, the 2 different RSPs, and then the TFSA, and then any other lump sum, keeping space for windfalls. Well, I've noticed cash value, I guess, how much it goes up by daily. Well, it's even different than the values you said earlier today, what they were a few days ago, because I wrote them down so I could know what they were for this call, and they've already changed in whatever that was, 4 days.
Yes, of course, because they'll go up every day, right? But here's what I wanted to point to. What you should look at. So if you look at your policy, right, 240 and change, and then if you look at your loan balance, and then tomorrow, obviously, the loan balance will increase by whatever the simple interest rate is, and then the loan availability will increase by whatever your daily accessible growth is, less the interest. Do you remember we talked about that?
Yeah, because that interest is always getting paid.
Yeah, that's right. So the interest, obviously, we structure the policy so that the interest is still always lower than the daily growth so that it's efficient, right? Mm-hmm. But what you can look at is you take those 2 numbers, add them together, and then you can say, okay, my total accessible growth every day is whatever, $20 or whatever that number is, right?
Mm-hmm.
So track that for a couple days, and then you can see what the total growth is, and then track it for a few days in a row, give it a week or something. So November 22nd is your policy date. Wait till you pay your premium and wait for those values to update or whatever. So let's say December 1st. Start tracking it a couple of days in a row in December 1st. Because if you had any values, I might even have some saved. If you looked at the daily growth in Desiree's policy this year versus last, you'll see that already the daily growth is becoming more efficient as well.
Yeah.
Right. So it's nice to see you get a raise, right? Every anniversary, your policy will improve. So
yeah, it's neat. And I'm I guess understanding it more, it takes a while to wrap your head around and get theory behind it. Last year I was even still this year, I was getting money and then say, just paying off my credit card. And then the last little bit, I was like, well, send it to Equitable and then pull it back out. And then that money's doing way more that way than just going from my bank account to BMO or RBC or whoever.
Yeah, totally. And that's the other thing too, like that people ask me about, they say, well, hey, Vern, let's say I have the money here and like, should I spend this money or should I use a policy loan? I'm like, well, I want to spend their money and then I recycle the money through the system. And they go, well, isn't that just make work? Why would I do that? Like I have the money available. I go, well, it's subtle. And I know you get this already, but it's not just about the fact that I'm now using Equitable's money. I'm also becoming a customer, a borrower from my own company. And then I'm taking the money I worked for and I'm giving it back to the company that I now co-own so that they have control of that volume of money. I can't illustrate the difference that that's going to make, but we know just by virtue of understanding how a business works, we're contributing to the profitability of that company and they have to share the profit with us. And I shared that with one of Jason's older clients. It was funny because at the event, she kind of walked up to me after I presented and she said, hey, like, that's what she said. Isn't that like a make work project? Like, why are you doing that? And then I said exactly what I said to you back. And she goes, I think I just got a light bulb. I was like, chew on that for a while. That's pretty cool.
And like what helped me understand it, because I understand the Smith maneuver a lot more than I understand in IBC, because I've been doing it for a bit long. But anyways, they're very similar. It's just where that money's flowing to first.
Exactly. Did you watch the replay or were you on that Smith maneuver webinar or no?
I didn't get a chance to watch it yet. So my last couple night shifts, I was able to watch a bit of the September client coaching.
It's interesting, right? Because again, I mean, I'm no expert at it, but it's relatively straightforward, right? You're paying down your mortgage principal, you're getting access to a readvanceable line of credit, and you're using that line of credit specifically for investment purposes to make that interest tax deductible, right?
Yeah.
So the only thing we're doing that's different, people say that too, oh, it's kind of like the Smith maneuver, or should I do this or should I do that? And exactly what you said. It's just where the money goes first. If I'm going to lump sum a bunch of money onto the principal of my mortgage anyway, why on earth wouldn't I use a policy loan to do that? And then I can, replace that money or whatever. But now I still have access to the line of credit. I can still invest. I can still get my tax deduction. I still have daily growth and a death benefit. And momentum on that money that's now trapped in the property. Well, technically, the principle of it's accessible, but you're picking up what I'm laying down. That's just it. You're just doing, it's the and asset, right? I have a client right now who I finally have a meeting with. The guy's had a policy now for over a year for him and his wife, and I think his kids, if I remember correctly. He makes too much money and he's too smart. He doesn't understand. He just goes, oh yeah, and he just puts a huge amount of money in the policies and the cash just sits there. Meanwhile, he's spending 20 grand a month to live his life and do whatever he's doing, right? And so the next time I meet him, I'm going to be like, man, like let's
gotta flow through it.
It's great that you good that you have the life insurance and you're saving money, but like, let's use it. Let's put it to work, right?
So like moving to this new house, because we put 20% down on it. So then able to do the Smith maneuver on it. So I'm going to use our 3 rental properties now, do the cash flow down on it with the Smith man. So that's going to be a huge combined with IBC and our policies. Like, and then you said like, use it to pay your vehicle insurance and your home insurance and your property tax and all that. So then you're just redirecting that money. Because it was like between insurance and property tax and whatever, say it was like $1,000 a month.
How many debits?
Now I have.
No, I mean, even with that, right? You have probably 3 different policies for those different types of insurance. You have property taxes, right? Like, you know what I'm saying? Automatic debits that were just coming out of your bank account all the time, right?
Yeah, like, so say Fridays after I get paid, it would be my RRSP would be gone. My TFSA would be gone. Start of the month was like vehicle insurance, house insurance, Desiree's vehicle insurance.
You got your trailer side by side.
Yeah, trailer and side by side. That was all in one payment.
Policy.
But still, same thing. Like a large amount, like $300 a month or something. And then utilities and the mortgage.
Yeah.
And then I'm putting $1,250 every 2 weeks into a savings account for premiums, and then Des is doing $300 every 2 weeks right now for her part of it. So then that, like, at $1,500 every 2 weeks, that grows fairly quickly. And then
right,
extra, fire it in there.
You feel like, I know you feel good, right? You feel good about all that and having more control, like less money flowing away, put money to work. And again, like I said, you're making a habit out of it. You're using the system. Yeah, that makes a big difference. And like I said, for me, I talk to clients, I call it the debit to deposit ratio. I'm like, we want to shift your debit to deposit ratio. We want to have more deposits than debits. I've had that. You might not deal with that, but I've had that before where I had so many automatic debits. I have money in this account and I forget to move it to this account, and then I get a freaking NSF. And I'm like, oh, and it's like so annoying. I don't have to worry about any of that stuff. Now when I get paid, I do look at my tracker. I take the amount that goes to my loan tracker. I put that in a specific policy, and then the rest of the cash, I just store it somewhere. When I need cash or when I'm getting low or whatever, I'll just look at my policy values. I'll think about how many months or how long I want this to last me. What do I have to pay for? I access big loans, and then 100% of my money goes back to the system.
So then are you using separate checking accounts to kind of keep that money separate? Like say your paycheck comes into one account, goes to Equitable, and then you pull a policy loan to a different account?
Yeah, I tried it. Exactly. I like to keep the, I call it commingling. I don't want the money commingling. I try to keep it separate. So I know specifically what money I'm using. So I have policy loans that go into one account and I get paid into a different account.
Okay.
Yeah.
So next step for us to make it a little more efficient, what do you think we should do? Should we start using some for our utilities, TV and internet bills?
Yeah,
I'm starting to do it for I'm paying for that painting, which is on our credit cards. So we both had offers through BMO to do balance transfer.
Okay. What does that mean? Like your debt or?
Yeah. So I paid for the painting with just a bank draft from my line of credit. And then we both had offers on our BMO credit card from the bank to do a balance transfer. So you are charged 2% of the amount you're transferring, and then it's interest free for a year.
Okay.
So I just say I pulled $18,000 on my line of credit to pay for the painting, and then I sent $9,000 from each of our credit cards to pay off the line of credit. So I was charged $180, but then it's interest free for the remainder of the year. So you only pay 2%. So yeah, I'm just letting that sit for now, and then I'm gonna use policy loans to pay that off.
See, you're working the game because again, you're disciplined and you know how it works. The sad thing is how many people are going to get screwed as a result of that, because most people are going to have 9, 10, 12 grand, whatever. Oh yeah, it's interest only or no interest or whatever. And then when it comes time to pay the bill, they're not going to have the cash to do it.
No.
Then they're going to work their tails off to try and pay that off for the next God knows how long and pay interest.
Which my dad showed me that credit card balance transfer because he does that every once in a while too, just like with his investments. Because he's like, pay 2% or 3%, and then I can make 9 or 10 throughout the year doing whatever, paid off. I can make a spread. So he's pretty crafty like that too.
Yeah, that's cool. And then just real quick, I was going to ask you, are you your credit card and stuff? Are you like a points guy or no? Do you care?
Yeah, so we do BMO air miles, and then we have an RBC, the WestJet.
If you want, just another thing that I do, but just the ones like you said, your utilities and stuff. I strap those to my credit card. I do the automatic debit. The only small risk, it's not a big deal. The only small risk is very rarely, they'll overcharge you by accident and they don't give you the money back. They give you a credit. That hasn't happened to me in a year, long time, but it happened one time a long time ago. But that's the only other risk. So that's what I do. I have 3 automatic debits that are strapped to my credit card as well, just for those ones that I can't pay the annuals or whatever. So I do that as well, get the extra points and stuff. Yeah,
because utilities are still coming out of my account. And then TELUS was, our TV and internet was on my credit card. And then they just send a notice that they're adding 2% fee to credit card transactions. So I switched it back to my checking account.
Right. Yeah, my wife told me about that. And now I'm like, it's almost like, maybe it's Parkinson's law, right? A luxury once enjoyed becomes a necessity. Now I'm like, nah, I think I'll just keep doing what I'm doing. But you had said something about becoming more efficient and what to use it for. Now, it depends on your specific objectives. Because you have a pretty good amount of capacity in the system, and especially this next year, it'll grow more and whatever. It depends on what your demand for cash is or what you're going to be using it for, some of those annual expenses and whatnot. But you could do that. You could, either one of two things. You probably have a specific account that your mortgage comes out of. You just set the money there and leave it there, and then it pulls it out. You could look at let's just say as an example, roughly, do you mind sharing, what's the mortgage payment roughly?
$1,800.
$1,800 weekly. Great. Oh, it's 18 bi-weekly. Ooh, baby. Yeah.
So Big house, like paid a good amount, and then
Sexy,
I put it on accelerated bi-weekly payments too.
Okay.
And then I started it at a 30-year amortization, but on the accelerated bi-weekly, it drops it down to 26 years. And then, so the reason we were able to do it is real estate investments. We sold some of our condos to our corporation. So we were able to get the equity that way to pay for the down payment. And then the whole objective is that I wanted to use the rental properties and then cash flow down the mortgage, paying it aggressively. And then we can afford that mortgage payment. So
here's a thought, 1,800. I mean, I know it's a little bit more if you average it out, but 1,800 basically twice a month. So we have $3,600 basically that we're paying for the mortgage. So if I multiply that by 3, so just under 11,000. So maybe it's a little bit more because of the biweekly. Maybe there's an extra payment in the month, depending on where it lands or whatever. So what you could do potentially for now, the thing that you could do is say, okay, you know what? That specific account that is anything else come out of that account? Do you get paid into that account where the mortgage comes out of?
Yeah, it's my checking account. So utilities, whatever. If I was paying my credit card, it would come out of that. Policy premium is debited from that. My savings.
It wouldn't be that much work just to make it easier. But what you could do is you could, call the mortgage company or the bank or whatever. You could change the bank account that they pull your mortgage out of. So we have this mortgage account. You build up your policies, take 12 grand out of a policy loan, plunk it into that account. Now your biweekly payments for the next 3 months are looked after. Same thing. How do we get an extra $29,000 into your policy as premium? Well, there's $1,800 biweekly that can go back into your policy as premium. You're going to be able to be that much easier to make sure you sustain your premium and have a lot more cash to replenish policy loans. And then every 3 months, you take a quarterly loan out specifically for mortgage payments.
So I think that'd be like the next probably logical one, because like utilities.
Now what you're doing is you're still paying your mortgage at the regular pace that you were paying it, but you're literally using the life insurance company's money. And again, same deal. Your money's going back to work in the policy. And then you just keep recycling it out, and you could use that. And your policy might be a good place to start or maybe even Desiree's, because there's a little bit of cash in there. But if I don't know what you're going to put in your policy, you could settle the base.
That was my plan, is do the base premium and then lump in the EDO throughout the remainder of the year.
Yeah, and you could do that if you wanted to do it, let's say, I don't know what month, but let's say whenever you have a target, let's say you have a target of a loan availability of, let's call it 12 grand. It could be January would be great, but let's say you just take your time, build that up. And as soon as you have that 12 grand, let's say available, do a little bit of work, maybe change that. I'm only saying to do that just the co-mingling. Maybe change the account for your mortgage, access a loan, plunk it in there. And then now, like I said, now you can start slamming more cash back in as premium. And then every 3 months, you just recycle that cash, take another 12 grand. And you're going to see that obviously you're building a surplus now on those dollars, right? Making your system work harder, and you can use the life insurance company's money to pay your mortgage. These are the little ideas, not right away, but these are the little ideas that come up where people go, how do I expand my system? How do I pay more premium? Well, we just have to get creative about how do we reshuffle the cash that's already. So once you start doing that and you're building a surplus in your system or paying down your mortgage, eventually there'll be capital available to sustain, more deposits.
So the amount we're saving bi-weekly now works out to about 50 grand a year. So there was, on my sheet, I had a shortfall of like $26,000. So I was kind of just like, say, well, we'll get some cash flow back from our rental properties. Usually I get a tax return. Desiree had a tax return last year. Put that in as premium and then just kind of leave that as for like space. But now I'd redirect the mortgage that's well above the amount we need to put into the premiums without coming up with any extra cash.
Yeah. So your base premiums for your system are easily sustainable, plus additional premium. And now essentially, for lack of better terms, found an additional pile of cash that we can go in to easily capitalize the rest and then work on the rest going back for policy loans.
Well, I guess we're buying a vehicle for Des too, in probably the next few months.
Yeah, and that's just it too. Because you would have, if you're recycling the money for the mortgage, that's just a payment that's happening anyway. There's going to be additional cash building up in the other policies. You could be using that for the debt recapture process to repay the car loan. And that's good because you have those tools available. That's why I say, to clients all the time. It's like we might not be able to do everything with the policy, but we can still do things because we have access to those other tools, like lines of credit or whatever. We can still achieve the objectives that we want to achieve with a lot more control and put more money to work and still achieve the objective of paying off the debt. You're not going to be stuck with a $500, $600, $700 payment for the next 5 or 6 years because I had to go finance it through the thing, or I don't want to pay 50 grand cash, blah, blah, blah. Right. So we can still achieve the objective just by shuffling things around a bit. So
yeah, and then like with the Smith maneuver, the cash flow down, do you know that side of it, the cash flow down? So like there's the plain Jane Smith maneuver, which is you use your annual tax return, prepay your mortgage, and then you borrow it back to invest. That's just plain Jane is what Robinson calls it. That's basic. And then there's 6 different accelerators that they have. So the cash flow dam, you have to have proprietorship, like business owned by yourself, not incorporated. So rental properties, perfect example. So you say you have 2 rental properties, your rental revenue or your rental receipts per month is $5,000. So you take that $5,000, prepay your mortgage, reborrow that back on the line of credit, and then that line of credit pays your expenses for the rental property.
Like the mortgage or
the mortgage, utilities, insurance, property tax, whatever else. So you're borrowing to invest. So it converts that non-tax deductible debt to tax deductible debt. So you're prepaying your mortgage at $5,000 a month.
You're like enhancing the Smith maneuver, essentially.
Yeah. So that he has 6 accelerators. So this cash flow dam is like one of the biggest accelerators. Like it has the most impact.
Yeah, I would say if you have that, especially those rental properties and stuff.
You can prepay your mortgage at $5,000 a month. You can convert that non-tax deductible debt to tax deductible in 6, 7, 8 years.
Do you have to look at, the overpayment, the mortgage penalty, or do you even care about that? Or do you just make sure you stay within that limit?
You do. But the other thing is if you do overpay your prepayment, so you work with like a Smith, so they have, do you know much about his program, like Robinson? His dad created the strategy, Fraser, in the 80s.
Right.
And then he passed away, and then Robinson, his son, has like taken over it, rewrote the book, and now he's training professionals like mortgage brokers.
That's cool.
Financial planners, real estate lawyers, conveyancers, whoever else to like learn the strategy and do it properly, because there's so much misinformation out there about it.
Talking about the accelerators, and you said, hey, do you know much about like the actual process? And that's what you talk about coaching. So
they have these 6 accelerators, and the cash flow dam is like by far the best. So you can convert your mortgage, and then it's completely tax deductible, and you maintain that debt level throughout. And then eventually, like Becky, I think is one of your clients, she's doing the cash flow down and then taking policy loans and paying off that line of credit balance and then recapturing it back into her policy. So that's what we're able to do here is, so we have 3 rental properties that we're going to use. We'll be able to prepay over $10,000 a month on our mortgage.
Wow. But then again, how long can you do that for? Like in a year though? Is that only like a few months then, or?
So that's where I was going. The mortgage. If you work with a Smith maneuver certified mortgage professional, they know which products are the best, and then they can set you up with like an automatic readvance. So like the Scotia step product automatically advances when you prepay. You're allowed 20% repayment annually of your base mortgage amount.
The balance remaining or the original mortgage? The
original balance.
Oh, sweet. So it's bigger. It's more.
Yeah. So with ours, we're able to prepay 20%, which is $146,000 a year.
How much?
Our cash, $146,000.
Oh, okay. Yeah. So you have a good 12 months, 120 grand if you're within
120 grand. So there's still space there.
Man, that's awesome.
Prepay. So we'll be able to like convert this mortgage in just under 6 years.
So that whole mortgage is basically going to be a line of credit in 6 years is what you're saying. Is that what you mean by that? By converting?
Yeah, like it'll convert to a flex line, and then I'll eventually lock it into an amortizing loan, which will drop my payment. And there's no new cash needed from you to like sustain this at all. So
basically, because by then, like the assets, the rentals are sustaining it? Is that what you're getting at?
Yeah, and just the ever increasing efficiency of the mortgage. So you prepay the mortgage, comes onto a line of credit. You pull that line of credit into a Smith maneuver checking account.
Oh, because that's what you can do with the step or whatever, right? Like you can segment accounts and whatnot.
So then the interest payment for your line of credit will come from that Smith maneuver checking account. So you're using borrowed money to pay the interest. So you're capitalizing the interest. So you never have to come up with new money to pay that line of credit. And then it's just each month your mortgage is more efficient. So there's more available on the line of credit to pay that interest. So our rentals are cash flow positive. So say we prepay $10,000 a month, there's $8,000 of expenses. Well, there's $2,000 there of free cash flow that you can use to invest in like a non-registered or just build up and use for other rental expenses. So the eventual goal is like, as we prepay, I'll build up enough so there's like a good cash flow reserve for our rental properties and then start sending some to invest. Now, after a conversation today, I'll probably redirect my mortgage payment to policy premium and then kind of redirect it that way.
Well, keep doing that. Keep making that headway. That's a lot of cash flow. So I'm thinking like eventually you could probably add more policies. Could just keep doing what you're doing, add more policies, but then we're using that just one extra step with the policy loans, right? But that is really, that's awesome, man.
The other ones, like, so the plain Jane is like you just use your tax return to prepay your mortgage.
Right.
Then they have the cash flow down. So if you have a proprietorship, you use that revenue to prepay your mortgage, you borrow from the line of credit to service the expenses on that proprietorship or rental properties. Cash flow diversion. So say this is another accelerator, you're saving $250 a month into a savings account, send that $250 to your mortgage, you prepay, you borrow that $250 back out, invest it in a non-registered account. Then you've brought that mortgage down, converted it to tax deductible. Debt swap, so same thing, like you're just converting bad debt to good debt. From the pump is like you have extra equity available, you use that. Yeah, like I think combining the two strategies is freaking powerful.
It's a no-brainer because it's like what you said earlier. It's where the money goes first, but you're not. It's the and asset. You're not doing this or that. You're doing both, right? Like that's
and that's like the Smith maneuver was able to click the light bulb for IBC, like how they have similar qualities. It's just that flow of money rather than coming in, going to your credit card. It does one job. It's gone forever. Send it to your life insurance, pull it back out. And same with the rental receipts. Because most people, they have rental property. I did it for the last 6 years. Rental income comes into an account, goes to pay the mortgage and all the expenses. But now with the right mortgage product, you can prepay that mortgage, reborrow it back out. And then the eventual goal will be to lump it down, I think, with policy loans.
Totally. And that's just it. While you're doing your whole accelerator and you're converting everything, what's happening to the policies over the next 6 or 8 years? They're just getting stronger. So when you're ready to do that, the policies will be really strong, have a lot of cash in them. You can start recapturing that amortized loan debt back in your system. Yeah, that's powerful, man. Think about, like you said, how much cash that is. I mean, all the stuff you already talked about, the Smith maneuver and all that, but how much cash you're sending back? Like what kind of an impact is that going to have in year 10? Like putting all that money to work and still achieving the same objective, right? Like that's going to massively accelerate your program.
Well, yeah. And then like just the Smith maneuver on this. So it's going to save, it was like 5 years and 4 months it's going to take to like convert this mortgage to tax deductible debt. It was going to save like $450,000 in interest.
Wow.
You have to earn pre-tax dollars or like after-tax dollars to pay your mortgage. So how much do you have to earn pre-tax to pay that mortgage plus the interest and principal?
To piggyback off, not only are you now in a position because you're marrying the two IBC, let's say, and Smith maneuver, not only that, you're now going to not just save all that interest that you were going to save, $450,000, how much interest that we're not giving up, right? The opportunity cost on that money, you're not just saving the interest now, but you're also putting that cash to work in your system and recapturing the opportunity cost as well, right? And building a huge legacy for your family all at the same time. It's pretty powerful.
So on a 30-year amortization with bi-weekly, okay, can you see that?
Yeah.
So this is the interest cost on a 30-year mortgage.
Good
for this house. And then, payments made, interest paid. So total interest.
Yeah.
72,000. And then this is how fast, I guess it's under 5 years, how fast we can convert it with the cash flow down.
The way that you've got, and they've got, I'm assuming, did that come from your team there? Like, how did you sort that out?
So I just did it on, if you just go to like Scotiabank mortgage calculator.
Right.
And then I figured out our annual prepayments, like took our monthly rental revenue, times it by 12, and then do that as a prepayment annually. It converts it out. So we're going to only pay $66,000 in interest.
Okay, this is awesome. Can you go back to the other thing for a second, just to make sure I'm capturing what I'm capturing? So the principal, the almost 744,000, that's basically the original, like that's the cost of the home, basically the amount that you mortgaged. Is that right? If I were to take, remember that rate versus volume conversation? So this, what you're showing is already an accelerated pay down. Is that right? So technically there's already less interest on this, or no?
Yes, because this is a 30-year amortization, but on a bi-weekly accelerated.
Right.
So you're making those 2 extra payments. So it already dropped it 4 years, 3 months faster.
So this is already more favorable, but you have a 4.2. Is that your actual interest rate, or did you customize that?
No, it's a lot higher now.
You have
variable.
You have variable. Okay. So if you scroll down, can you go back to that for 1 second? So basically, if we take 471,000, well, let's just call it 472. We take 472 and we divide it by, let's call it 744. That means based on, if I'm seeing this correctly, that means based on this, the volume of interest. Yeah, you could look at it. Actually, yeah, that's the way that we want to do it, I guess. We'd want to take the 472 and divide it by 1.25. 1.25.
About 40%.
About 40%. So that is exactly what we're talking about, where because how they structure the loan and all that kind of stuff, they can tell us on paper, the consumer mind looks at 4.25% and goes, oh yeah, whatever. Okay, great. That's what I'm paying. But what they don't realize is the volume, the percentage of every dollar that's flowing away, 40% of it. This is if you don't refinance. This is if you actually follow the schedule. There's no change in the interest rate, yada, yada, yada. You're paying 40% volume of interest. But then just by shifting what you're doing, shifting the process, you're paying now, that's probably closer to, I don't know, 10% or something. And then on top of that, by implementing the process, becoming your own banker and putting money to work, like you said, the first place that it goes, I mean, you're crushing the game. Like you are massively getting ahead of where you would have been and massively getting ahead of your peers.
But what made this move okay,
right,
was we had the equity available and then we were able to do the Smith maneuver, had the rental properties in place to do the cash flow dam, and paired it with infinite banking.
That's awesome, man. So no doesn't always mean never. Sometimes it means not right now. So you weren't able to do the Smith maneuver. You hadn't discovered IBC because you kept doing what you're doing, obviously following the process, becoming your own banker. But the other thing that's important to point out is you're coached on multiple levels. You're obviously working with our team for IBC, but you didn't just I'm sure you made mistakes, obviously, but you're working with people who coach, working for real estate investing. You're working with a certified, what's it called? Smith maneuver specialist now. Like you are coachable, you're learning and you're expanding, and look how it's impacting your family and your program and probably your peace of mind too, right? Like God forbid, crap hits the fan. You've got options. You're not just paycheck to paycheck or whatever. You've got options. You got policies, you got cash, you got lines of credit. You can change and modify your payments. You're doing all these other things. I'm not trying to pump your tires up too much, but you're doing well, man. You're doing really awesome.